Great. All righty, so let's get going. Today we're going to talk about multifamily lending in the COVID market, and I want to make this interactive. So as those of you who have come to our live meetups way back in the day when we used to do those, I welcome questions. So if you got any questions, feel free to jump in and ask. I want to get as much value to you guys as possible as we go through this. And there may be some quote unquote tangents that we may take that actually are good learnings for the group. And so, but we do have an agenda, so I want to get to it. Oh, we got 2 more people coming in. Let me let those guys in. That Aaron and Arlene. Can you guys hear us or hear me?
I can hear you, Malcolm. Can you hear me?
I am. How you doing, Arlene?
I'm doing well. How are you?
I'm good. Good to hear you. All right, so let's talk about multifamily lending right now. The key factors that are affecting lending right now is one, unemployment. Right now, the new jobless numbers came out this morning, 1.1 million new claims. So we've averaged over, last week we had a dip below 1 million, and we're expecting the number to come in at 920 today, but it ended up coming in at 1.1. So, we're still going through, obviously. That's going to be an issue because obviously when you talk about coming in to a market where unemployment is up in the air, that's going to be a challenge. So, I see Devon is calling me. All right, sorry about that. So that's going to be something that we're going to have to watch and be careful, because what lenders are kind of skittish of is if unemployment doesn't clear itself up, what are the payments going to look like in September, October, the rest of the year? How bad is it going to be? Evictions obviously have been halted, as most of you guys know. Hello? Okay, so evictions have been halted, as you guys know. And so one of the concerns is, okay, when these folks are no longer protected, if you would, what's going to happen with mortgages? So that's affecting the underwriting that's going on right now. But here's the big positive, though. Liquidity. Liquidity in the commercial paper market is huge right now because the 10-year treasuries are at record lows. And everything is a function of 10-year treasuries. So with 10-year treasuries being less than 1% long term, there's an abundance of paper, i.e. mortgage money, available, because bond buyers aren't making any money in the bond market. So because rates are low, you guys see what CD rates are right now. I mean, it's terrible. So it's a lot of liquidity. Now the money is kind of skittish right now because, everyone wants to make money, but they're more concerned about not losing money. But there's a lot of availability of money. So it's just a matter of the right deal, the right property, the right location, the right borrower, all of that kind of stuff. But it shouldn't be an issue of money in the market. Money is not tight right now. Third factor affecting lending is forbearance and foreclosures. And so as you guys know, there's a lot of people in workouts right now. The last numbers I saw were between 4.5 million mortgages that are in workouts and in foreclosures. The same, now that's including all mortgages. The mortgages that are in multifamily specifically have, for the most part, held steady. They have been slightly affected, but no one wants to go back to 10 years ago where banks were foreclosing on everybody, willy-nilly, if you would, because inventory got too high and prices went too low. And instead of making, 70 cents on their dollar, they were making 20 cents on the dollar, and everybody got killed. So most lenders are trying to work it out, and my firm, Castle Commercial Capital, we've got a couple of people who are late, and we're doing everything we can to work with them, because the last thing we want to do is foreclose. Nobody wants to foreclose. It's not good for anybody when that happens. And right now, as some of you guys know are active in the market, prices are pretty high right now. Prices are pretty high and inventory is pretty lean. We do not expect that to continue going forward. So we does not expect that trend. As some of you may know, there's a normal foreclosure volume that happens in the marketplace in good times or bad times. And that has sort of been shut down for the last 6 months. So when you have, 6 months of the normal foreclosure inventory being dumped, if you would, onto the market, that's going to cause prices to go down. Right now, sellers aren't totally realistic with the marketplace that we're in. They're still demanding what a lot of investors feel are higher prices. But again, we don't expect that to continue. Now the big caveat to everything we talk about is, frankly, the state of COVID. If the government comes back with a vaccine relatively quickly and we're able to get back to normal, whatever normal is, relatively quickly, all bets are off. Going back to the second point of liquidity, there's a ton of money in the market that's just waiting for things to normalize, so everybody can get back to making money. Now the job market is going to be a variable. Obviously, how fast is the job market going to bounce back? Who knows? But if the COVID thing ends up having a relatively short shelf life, if you would, that will definitely precipitate a bounce back in the market. On the flip side of that, obviously, if we have a vaccine and it's ineffective, or we don't have one at all, or before we can even get one to market, a second wave happens that's just as bad, if not worse than the first, then again, all bets are off. So that's the cloud, if you would, that's hanging over all these numbers that could drive it one way or the other. So as investors, I think it's just prudent upon all of us just to be careful and to be prudent. And if a deal's too good to be true, hold off. This is not the time to gamble and roll the dice. Trends to watch. Number one is going to be the CARES Act and the extension of the 600-week unemployment insurance. Now, the reason we're talking about that is because a lot of people who've been out of work have been able to pay their rent because of that extra $600 a week that's in their unemployment insurance. As some of you know, most states cap out around $300, between $300 and $400 on their unemployment. And when you're that low, a lot of rent's not getting paid, but with that extra 600, people have been able to maintain. And as some of you may know, what happened in March, we had a pullback in the market when the first shutdowns happened. And then lenders saw rents were being paid in April, May, June. And they're like, oh, okay, well, rents are still getting paid. Okay, we can go back to lending again. Even though they did increase their criteria, they still went back. And a lot of lenders did open back up to lending. If we don't have that floor of that $600 a week underneath a lot of these unemployed people, you know, it could get real rough out there. So that's something to watch and to pay attention to. Because also in that CARES Act is more extensions relative to evictions and forbearance and that kind of thing. And it's subsidization on the market to help support the housing market. So it's going to be real key if it gets, well, and now it's the HEROES Act. If the new HEROES Act, which is basically an extension of the CARES Act, if that gets passed, we'll see. I just heard something yesterday from one of the senators saying they expect after the convention, the Republican convention next week, that they're going to come back to the table and try to hammer something out. Because as you might imagine, these guys want to campaign and they're getting a lot of gruff from their constituents about, you know, that $600, about evictions, about, you know, the Postal Service and all that other stuff. And they're like, you know what, we have to have something to show these people to run on re-election. So that's something to watch. The other thing is look at the rent collection and eviction numbers. Pay very, very close attention to that going forward. I just read an article yesterday that rent collection for affordable multifamily housing units was at 75%, which is quite a bit higher than it had been the previous month. So, you know, going forward, we want to be concerned as in obviously investors in multifamily, that those collection numbers are substantially higher than that. That doesn't necessarily mean people are going to go to eviction, because if they were late on July rent, but they made June, then, you know, they're not in eviction territory. But it's something to be concerned about, you know, as well as the eviction numbers. So as some states have already opened up, some communities and counties have already opened up for evictions. And so we want to watch those and see what those numbers are going to look like. Because if those numbers get too high, then lending is going to tighten right back up. Any questions before I move on? Any questions about any of this stuff that we've gone over thus far? I know I've gone over quite a bit. Hey, Aaron, how you doing?
Awesome, awesome. Can you hear me?
I can. Look at all smooth with your sunglasses on.
brother. It's all good, man.
There you
I'm
go.
glad to be here.
Yeah,
Where's his
glad to be here.
dreads?
Yeah, I'm looking at that beard, man.
Who is that?
J.
Who
Cole.
is that? Who said that?
J. Cole.
That was J. Cole.
Oh, J. Cole, the man. All right. Yeah, man, I just coming back from on the road, man. So here go Mr. Jackson on the line too. All right, we got the whole crew on here. Yeah, everything's good though, fellas, man. Blessed to be here.
Good. Does anyone have any input on any of these issues that we talked about thus far? If you've seen anything contradictory even to some additional information that you've read or seen.
Hey, Mel. Oh, sorry. Okay, thank you. Hi, this is Kara here. So I had a question on your note about lending where you're saying money is available. I heard recently where we can expect bridge loans to be especially tight. Do you have any insights on that?
Actually, I do. I talked to, as you guys know, Castle, we're a lender, but then we also have a broker hat on. So if we won't lend on something directly, we'll put our broker hat on and work with other lenders. And I just talked with a bridge lender 2 days ago who lowered their loan amounts because they saw that there was a gap in the marketplace for small multifamily. And typically this lender always did deals $1 million and above. And they actually dropped their minimums down to 500,000 because they're like, there's a big group of people that are not being served by the banks, you know, long story short. So they think it's an opportunity to take market share. And they're a bridge lender. So that right now, again, going back to that point, Kara, about the 10-year treasuries being so low, you know, bridge lenders are funded by private investors, right? So someone may have $500,000 sitting in the CD making nothing, and they'll donate it to, I say donate it, they'll invest it with a bridge lender who will say, hey, I'll give you 6% on your money. You know, a 6% normally isn't a high interest rate, but compared to what they're getting right now, that's a pretty good return. And then, of course, if the bridge lender's charging 8, 9, 10%, then they're making, you know, a good return on that as well. And right now, bond investors really have nowhere to go. So I don't expect bridge lending to tighten up at all, you know, not based on the people I'm talking to.
Okay, awesome. Thank you.
You know, J. Cole, you want to throw your hat in there on that?
Well, yeah. So just in the lenders that I deal with, I have a relationship with Blackstone, so they increased their exposure limits from 2 million to 10 million after June 15th. So I don't know if that was some deliberation that was going on pre-COVID, but definitely after they read the tea leaves, folks were still making payments. They decided, hey, let's full-fledged get in the space and take some of these opportunities off the table. And the other piece is the Democrats are at 3.1 trillion. The Republicans are at 1.3 trillion. They've called their acts different names. So Democrats it's heroes, Republicans it's heal, and they went home for the vacation, right? To politic and fundraise, go well, virtually go to stuff. But at the end of the day, they went home for the holidays, where folks are like, hey, what the heck? Get back and do your job. So yeah, that's all I've been paying attention to for the last week and a half, and it's scary times. Scary times.
It is. There's no doubt about that. And I think at the end of the day, we as citizens own part of the mess, right? Because we have to hold people accountable. And as I like to say, you know, you shouldn't always look to blame the other guy. Sometimes you got to go to your friends and say, hey, listen, I love you. I support you. You know, I'm your boy. I'm your girl. But you got to get your stuff together right now because you're messing up. And friends should be able to tell their friends, listen, you need to get back on the beaten path because you're starting to go a little left. You know, and
to your point, but go ahead. Well, let me say this. So to your point, in Detroit, right? That's where I'm at. I'm literally sitting on 7 Mile and Otter Drive, literally 3 blocks from where I grew up. And in Detroit, 14% of our electorate turns out on a continual basis. And then once the boogeyman was in 2018 for the midterms, we had 100% increase to 28%. So the largest voting block is the folks who stay home. The apathy is killing us. Right.
And I think you could take those numbers, Jay, from 2018 across most counties. Voter turnout has been up everywhere. You know, a lot of people who were apathetic are waking up, and dealing with the money class, the investor class, right?
Yep.
You know, those guys are, you know, Democrat or Republican until their money gets messed with.
Right.
And then
Yes.
Right. And then they're like, okay, listen, I don't care who you are, you got to get this right. You know, so I think there's a lot of pressure from the donor class who contribute to these campaigns in both parties to smack these guys upside the head and get something going. You know, I've been saying this for a while. If there's one positive about COVID, if it had to happen, at least it happened in the election year. You know, because as bad as things are, they would have been a gazillion times worse if this was like 2017. You know, or 2019. You know, but given that, you know, where we're at right now, if they're going to do something, this is the time, you know, for them to do it. And we'll just have to see how that goes. Let's go on to opportunities. Opportunities in the marketplace. Class B in affordable housing. And specifically for some of you guys who come on a little late, we've been talking about multifamily. And with Class B and affordable housing, that particular part of the sector of the market is able to weather the financial storm better than other parts of the multifamily market. You know, I spoke to a lender the other day. We were talking about senior housing, right? They're not touching senior housing with a 10-foot pole right now. Obviously, with COVID and how much is raging through the elderly community, they're not trusting anybody's numbers right now. They're definitely in a wait and see when it comes to senior housing. When it comes to student housing, well, same issue. My daughter was supposed to be a freshman. She is a freshman at Wayne State, and she's going to be virtual. You know, she was supposed to go into the dorm. You know, so that dorm is shut down right now, so she's going to be home. Now, you know, that's going to save, you know, daddy over here about 12 grand a year. So I ain't mad at COVID for that, right? But for Wayne State University, that's a lot of money when you take that over their student population. And Michigan State, University of Michigan, you know, all these schools, same thing. So, but when you look at affordable housing and Class B as a sector, they're actually positioned to do well. Because if you think about with market rate rents and luxury apartments, they're at the top end of the market. You know, if a guy's making 100 grand a year, then he gets laid off or he gets downsized or whatever, that's going to affect him more. And he's going to have to downsize into a lower level apartment. He may go from Class A space to Class B space, right? Class B are not moving up into Class A right now, given the uncertainty that's there right now. With affordable, same thing. You know, people in affordable housing, you know, they're paying, you're always going to fill those because you're at the low end of the market. So as economic times get tough and people have to down market themselves based on what they can afford in their new normal, right? That means there's going to be opportunities in Class B and affordable housing to stay relatively full compared to other sectors. Now, the other thing about Class B is one of the changes that we notice taking place is there's a shift to work from home, right? And a lot of companies have used this time to say, you know what, we've got 70% of our workforce working out of the house and we're doing just fine economically. So we may continue that trend. So one of the things you find sometimes with Class B space, a lot of Class B apartments have a lot of space, physical space. So when you talk about bang for your buck and someone who's in a luxury apartment, they may be able to afford that apartment, but they says, you know what, if I'm going to work from home, I'd rather go to a Class B space where I get an extra bedroom that I can use as a home office, you know, than staying in trying to do business at my kitchen table, you know. So Class B and affordable is well positioned, given the economic times that we're in right now. Second one is valuation decrease. We talked about this earlier. There's, you know, in theory, if economics supposed to work right, there will be a decrease in pricing at some point, right? So which means is there's an opportunity as an investor for me to buy at a really great price, you know, moving forward. And so I just need to be more finicky as an investor when I'm shopping for real estate, and to have my eye on these decreases. You know, especially, and getting something Kara mentioned earlier about the bridge lending situation. You know, if someone has a increase in their vacancy, you know, they may be more amenable to sell than they were 6 months ago. You know, and the money's going to be there for that investor to buy that property. You know, now they're not going to get, you know, if a property is sitting at, let's say, 30% vacancy, okay, they're not going to get that at a 5% interest rate loan, but they can still buy it at a lower price, do whatever they may need to do with it. Because one of the things that we found is management has gotten lazy. And a lot of people haven't managed these properties as well as they should, and now times get tough. You know, so there's an opportunity for a lot of places to have new management come in, manage those properties correctly, and bring up the profitability of some of these properties. Third opportunity, Section 8 and veteran housing. You know, a lot of people have been sweating bullets like, oh my God, what am I going to do? Biting their nails about rents, collection, and evictions and all this stuff. Folks who've been renting to Section 8 people, though, folks who've been renting to veterans that have a Section 8 type subsidy from the VA, they ain't missed a beat because that government check has been coming in month after month, and they've been fine. They've been absolutely fine. And I've had some investors approach me that are looking to buy more of that type of house, where before they were like, I think I wanted to move up to market rate. You know, they're like, oh no, I need more of these. I need more of these. Anyone want to comment on that, to what you've seen in the marketplace? I know, Aaron, you're in the business.
Yes, sir. I'm echoing there's a lot of interest in multifamily performing assets now, no matter what class, almost A, B, C. We've got numbers in some areas where us from Detroit know, like on Dexter and Linwood, properties that, or neighborhoods or blocks that we would not normally invest in. We've got 15, 16 units going for $850,000 on Richton. I know, Jason, right? I knew I'd get a reaction out of Chaco. On Richton off of Dexter, man. Unheard of. Right. But that's because the economics make sense for New Yorkers and Californians. You know, they see Section 8, and that's how that deal got done. It was Section 8. They came in and paid way too much for it. I think they paid $400, $450 for it, put a couple hundred in it. And I said I thought it was going to sit on the market forever, but Section 8 was appealing to the buyer. The buyer came in, the numbers looked good. I think it was a low teens cap rate, 13 or 14%, and they scooped it up. So deals that we think wouldn't happen, man, they're happening. So that's got me re-energized and excited about this. And Section 8 and veterans is the new. Those are getting a huge bump. Yes. There's 200 units right now, as a matter of fact, on the market. We're looking for 200 units to put transitional housing for vets in now. So
I'm hearing the same thing. And Aaron brings up a very good point. Investors, out-of-state investors, from California and New York, for different reasons, see Michigan as very attractive. You know, and as bad as the COVID thing has been nationwide, compared to most states, Michigan has done pretty good. You know, California is still, you know, catching it right now. New York their numbers are through the floor. You know, I saw yesterday their what do they call it? Their positivity test rate is like less than 1% now. They're doing fantastically well with managing, but the problem is the rent laws that they changed earlier in the year have been a disincentive for New York investors to buy more New York real estate. You know, they were ticked off before COVID happened. And even though, you know, they made it through the COVID issue because of the law change and they put caps on how much they can raise rents in New York now, they're like, you know, I'm not putting any more money here. You know, so they're looking at the Midwest as a big opportunity. You know, that means we're going to have more competition here, you know, on the buy side. But if you're on the sell side, you got to be happy about that. You know, so I wanted to go through some specific underwriting criteria because we're going to talk about like what deals are getting done and how they're getting done. The minimum FICOs have jumped up, bridge loans and agency. Right now, 700 is sort of like the standard that everyone's looking for. Now, there are exceptions to the rule. So if the deal looks really, really, really good, they'll go down to 680. But most of the time, they want to see 700 as a FICO. The minimum loan amounts right now are around 500,000. If a deal is less than 500,000, can it get financing? Yeah, it's just tougher to get done. It's just tougher to get done. Because you think about it from this perspective, the more units that I have, the more protected I am in case of a downturn. And so, with smaller unit properties, say 8 units, 10 units, I don't have as much. I don't have as much downside protection as I do if it's 20, 30, 40, 50 units or more. And so that's sort of what's at play. Now, if it's 8 units, 10 units, can it still get financed? Yeah, but the deal's got to be right and tight. Loan leverage, right now we're looking at 75%. If the deal is, gorgeous and perfect and everything is great about it, maybe 80. But most of the time they're looking at 75% loan to cost, loan to value. Rates can be as low as 4%. And if we go into bridge loan territory, it can be as high as 9, 10%, just, depends on the property. So the one thing right now, every deal is a manual underwrite. Every deal is being looked at individually. Location, borrower, condition, liquidity, all these things are coming in into play. And so you may start out at a rate of, say, 6%, and then they'll say, well, man, based on liquidity, we're going to have to add another quarter point for that. And because of location, we're going to add another half a point for that. And because of condition, we're going to add another. So, and that's how loans get priced. So they have a base rate, and then they have risk factors, and they add on those risk factors. Now, if someone has a 740 credit score or 750 and above, they may say, oh, we could take off a quarter point off the rate because their their credit and their net worth is so high, we feel more than comfortable. Points, right now, I would set as an expectation 3 points. If you get a deal now, you're only paying 2, fantastic. If you end up at 4, not too far away. Ideally, you would want to do 2 to 3 or less. But sometimes it's a matter of getting the deal done. And if the deal makes sense, I wouldn't, not do the deal because I can't find someone that won't do it for less than 3 points. Your mileage may vary. But as an investor, you just price that into your deal like everything else. Term, 5, 7, 10-year arms are typical right now with the balloon. It'll be a 30-year amortization, but the note itself could be 5, 7, or 10 years. Now you do have some loan products that are fully amortized 25-year or 30-year loans, and you have some cases where the loan is a 30-year loan, but the interest rate is only fixed for 5 years, and then it adjusts annually after that. So there's a lot of variation, but that's something just to expect and be typical. With Fannie Mae and Freddie Mac, and what we call agency loans, because those are government-sponsored enterprises, your rates are going to be really low, but your minimum is going to start at 750. We look at the Freddie Mac small balance program. So just also have that in mind. Your best rates and terms are going to be when you're at 800,000 and above. The bigger the deal is, the better the pricing. This is no ifs, ands, or buts about that. Any questions about this at all? Anyone seeing anything different?
I was just talking to a guy out of Illinois who focuses on vet housing because I was trying to get some information on that. And he was mentioning to me it's like 70% of the demand for vet housing are single bed, 1 bedrooms. Because you have a lot of guys and female that are just going through some things and they don't have anyone around. So he said single 1 bedroom apartments were like
right.
a high demand for the vet housing. So I wanted to add that.
That's right. And so another investor told me that even with the 2 bedrooms, the check that they get from the VA allows them to actually share that living space with someone else. And so some of them are actually looking to double up guys just because they can't, you know. And so, you know, I haven't, personally, I don't invest in that stuff. So I haven't seen that. But you know, that's what, and I've heard that from multiple investors. So I'm assuming that to be true.
Yeah, another thing that he mentioned is his niche is divorced military mothers. You know, they qualify for the VA program, but they have kids, so he rents. You know, he focuses on single families, but he, you know, gets 3-4 bedroom houses and throws divorced military women in the military who have kids in them, and he's just getting, you know, this top dollar rent, I guess, for it. So it was pretty interesting, his point of view from that.
Yeah, because the one thing too with the vet and the section housing, we look at how much rent you're getting per square foot. It's a very profitable niche. It's a very profitable niche. So that was all that I had today on multifamily. Any other questions or things you guys see in the market just in general, or, you know, other type of property that you guys might have questions about, or financing?
A broad question here, but I'm newer to multifamily, and I've been learning about working in an area where there's a diverse job market. Have you been seeing any particular job markets take a bigger hit than others? I mean, the things that come to mind for me are like service industry and tourism, and maybe government is holding strong. Any other thoughts on that?
Well, I mean, the restaurant and market is getting killed right now. Hospitality is getting killed right now. You know, I mean, and you know, some parts of the gig economy are getting murdered. And I just saw an interesting fact the other day. I don't know if some of you guys saw this, but Elon Musk just became this week the 4th richest guy in the world.
Yes.
He's only behind Bezos, Bill Gates, and Zuckerberg.
Warren Buffett. Oh, really?
You know, and that's because Tesla stock has increased 300% this year. You know, so and there are, when you look at the stock market, there's about 10 stocks that if you remove them from the stock market's down. You know, Apple, I believe it was yesterday or this morning, I think I was watching CNBC this morning, and Apple just crossed $2 trillion of market cap.
Yep.
You know, which is amazing. But people are buying what? iPads and MacBook Pros and all this stuff working at home. And, you know, with Microsoft Teams, you know, they're making a bunch of money in the corporate market with Microsoft Teams because they have better security than Zoom. And there's some, you know, other type of benchmarks that they can see how long someone's been on, and they can monitor the activity of a remote workforce a lot better with Microsoft Teams. And they're all making just a good gobble of money. And where the market is flowing to is, where's the future? And so the tech of the future, that's what's driving a lot of the investment dollars. So, you know, when you look at jobs of the future, you know, for example, people that are selling like Logitech, they sold out of webcams everywhere. You know, I mean, talk about it, you know, as a company, I sold out of everything I make. And on the eBay market, used product, you know, is selling for higher than retail new that you can't get a hold of. You know, and Logitech is trying to go to market with across all product lines. They're trying to get stuff out there as fast as they possibly can. And the thing is, Kara, that trend, no one sees it ending anytime soon.
Good problem to have.
Right. The other thing they talked about on CNBC the other day is a lot of companies weren't actually hurting, but they said, you know what, we're going to use COVID as an excuse to trim our labor force. Because, yeah, they could work from home or we could still be profitable, but you know what, this is a good time and no one's going to hate us. We're not going to get bad press if we lay off 10,000 people right now.
Yep.
You know, so a lot of them did, you know, and then ironically took PPP money at the same time, you know, and you know, there's this push now that's not ironic where you've got some people saying, oh, we should just forgive all the PPP loans. Where is that coming from, right? Because technically for that loan to be forgivable, you got to have those employees there. They don't want to bring them back. So it's cheaper to lobby their senator to say, hey, let's just make the whole thing forgivable rather than, you know, enforce the conditions in which they got the money in the first place, you know. So, you know, I think things like delivery service, trucking. I talked to an SBA lender the other day, and we were talking about markets that are hot right now. Businesses are being bought at a really good pace right now. There's a lot of opportunities for people to come in and buy businesses. And one hot part of the market, little sector, is delivery. So you have these private companies that are contracted with FedEx or contracted with Amazon, right? And those guys are doing gangbuster business. You know, and as more of us stay home, that business is not going anywhere. You know, because if we can't go out, those goods and services have to come in to us. So if you're in logistics, or you got tenants that work in logistics, they're going to be fine. They're going to be fine. Any other topics of interest?
Hi, Malcolm. Quick question for you. Is there any talk of infrastructure spending as a way to kickstart the economy or to get people back to work? And where do you foresee some of that infrastructure, this is governmental infrastructure spending, where do you see some of that money going?
Well, right now, one of the campaigns, I won't say which, I won't get into a political fight with anybody, but one of the campaigns is putting forth a huge infrastructure bill. Mm-hmm. And they're like the best way to get out of this mess, recognizing that some of these jobs, you know, and the last numbers I saw, there's something like 30 million people unemployment this year over last year this time. Okay. So some of those jobs are never coming back. There's a new small business survey said that 40% of small business owners who are open right now said that they have to go back into shutdown, they will not reopen. Mm-hmm. There's just, you know, there was a woman on the Democratic convention video yesterday. She had a restaurant with 100 employees. She actually had 2 restaurants. One of them closed, and then the other one, she's hanging on by a thread. And she's like, I maybe have like a month. And then I don't know what's going to happen after that. You know, unless something, you know, unless they get some more support from the government, you know, they're going to be out of business, you know, which is crazy. And she had just had one of her breakfast dishes wrote about in the LA Petite edition of the paper that was raving about how good their food was. And she's like, we had people outside in line waiting to get in before COVID happened, you know. So what's going to happen to those people? Well, one of the campaigns is proposing we put them to work for infrastructure. We need new bridges. We got a ton of bridges and roads in this country that are crap that have to get fixed, right? We should do that. Another idea that they have is going to again, 21st century solutions, which is put these people to work with solar, wind, high speed internet, because there's a lot, especially in rural communities, there's a lot of communities that still don't have high speed broadband. You know, so if we subsidize the building and laying of that, you know, pipe. I mean, right now I'm on this call with you guys and I have fiber optic, right? And that fiber optic cable has to be laid, right? Literally to my house, right? So, you know, they came in a couple of years ago and they said, hey, we need to come in and we need to add this fiber optic to you. I was like, well, listen, I'm not buying anything. Oh, no. This is infrastructure. This is for the whole neighborhood is getting laid for fiber optic. So if you don't have to buy it, but we still have to lay the cable up to the house. Right. And I was like, yeah, okay, you know, whatever. You know, and then last year I said, well, let me switch from Xfinity to AT&T because AT&T was who's offering the fiber optic. And it is a huge difference. Yeah. It is a huge difference. Everyone in my house can be on Netflix at the same time and you would never know it. But there's some folks that still don't even have decent high-speed access. And that cable has to be laid by somebody. Yep. The engineer has to do the surveying of the county and figure out how they're going to do it. And I think if they win, I hope they do. I think that's a good plan. Yep. You know, I mean, we don't have to give checks out to anybody. You know, we just have to support industry, right? Yep. The right way. And that's where those jobs are. Okay, great. Put someone in. My brother-in-law went into a training program about 5 years ago on solar, right? He's been busy ever since, because that solar market has doubled from where it was 5 years ago. Yep. You know, and there's still so much more that it can go. You know, they could easily hire more people if, you know, you provided a subsidy for that. So, you know, I think that's where, you know, the future is. And if we crack the code, whichever country in the world cracks the code on abundant clean energy, they're going to have a tremendous advantage in the world marketplace. Yeah. And so we got to be first. Just like example, we set the stage on the computing industry with IBM and Apple and Sun Microsystems. You know, Intel, we set the bar, and then the whole rest of the world is catching up. But while they're trying to catch up, they got to buy Intel servers. Yeah. You know, so you know that's the next great frontier. There's a lot of money being invested to make that happen. Just like there's a race for the vaccine, you know, whoever's first to market, you know, is going to make a ton of money. You know, they're going to do that with they're trying to do that with clean energy and infrastructure. Infrastructure. And infrastructure. Yep. And infrastructure.
Yeah, that's why I wanted to hear a little bit about what's happening in that regard, because as you just said, you know, as more and more people are going to be working from home, and there's a lot of remote communities where they don't even have adequate, you know, things like internet and other types of things, services to be able to get in and out for deliveries or anything else. Infrastructure investment gets people back to work and it creates employment, and those people need a place to live. So.
Well, and that's also why, going back to something we said earlier, Tesla jumped 300%. Yep. Right? Because Tesla is best positioned for electric moving forward. And so, you know, they've been doing it longer than anybody. They've worked out the bugs and they've got the manufacturing, because they had the biggest battery plant in the world, yep. Right in California. Yep. You know, so they've got They got the infrastructure to take advantage of that, and that's where the future is going. And I was looking at something talking about the trends in trucking, right? Right now we're sort of in a chicken and the egg situation with electric. Do you get the vehicles first, or do you get the infrastructure? Because you have to have all these charging stations everywhere, and they're working on that, trying to figure that out. But one of the industries is going to be flipped upside down is trucking.
Yeah.
Because it'll be much more efficient to have autonomous driven trucks that, guys don't get tired, they don't get sleepy, they don't need vacation, right? They go exactly where you want them to go,
Yep.
right? And there's been enough testing, and everyone's been doing it. Google's been doing it. Ford, Chrysler, GM has been doing it. Tesla's been doing it. There's been enough studies to say, what, this autonomous driving actually works and is safer than humans. The question becomes, how do you get us used to it and give up our vehicles, right? But I saw something the other day. It was a movie. A woman got in the car, and the windows went opaque, and the car took her to her job, and she was working in the car the whole time. Talking to people, making deals, yada yada yada. And the car got out, and I was like, man, how cool would that to actually have right now? It's like an Uber driver doesn't give you attitude. Or you're there, you're like, oh my God, okay, yeah. I'm just saying, but that's where the future's going, and I took a lift, I think it was, or I think it was a lift about 6 months ago, and I was like, man, this is awesome. It cost me $8, to go from where I went to work to my destination. And I was working in the car the whole time. And I was like, yeah, dude, how you doing? And I got out and I was like, hey, see you later. And I had to worry about parking. I had to worry about fighting traffic. I was like, man, when I get my car was like in the shop or something, I was like, man, when this thing gets out, do I really need to keep this thing around? Right? Because it wasn't that much money, right? Compared to, what I'm paying for my vehicle and insurance and, blah, 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 blah. And, gas and everything. I'm like, man, $8. I'm doing the math. I'm like, this is like half the cost of me having my own vehicle. Of course, we like, it's our freedom and we want to go where we want to go. But eventually we will get there. And those people who are first to market are, they're going to be billionaires. I mean, there's no ifs, ands, or buts about it. I see Jason made a note in the chat. Jason, what were you saying about the Senate infrastructure bill, that 1.3 trillion?
Yeah, so the Republican Senate created an infrastructure bill kind of valued at about 1.5 trillion. And it has a whole lot of gobbledygook that the Democrats hate. So clearly it favors a certain group of folks. And they are in a tussling match trying to get it, trying to bring some other light to it. So we shall see. My expectation at this point, because it's the same infrastructure bill that got created in 2011, literally 2011. Okay. Yeah, and so this, this horse trade that needs to take place, will it happen? Because you've got an election on November 3rd or whatever the post office ain't gonna do. So yeah, we'll see.
One of the things politicians know how to do is get elected. They don't know how to get any business done.
Say that again, Devon.
The only thing that politicians know how to do is get elected.
Yeah.
They don't know how to get projects done efficiently. Because like Jason was talking about 2011, we've been talking about infrastructure for 10, 12, 14, 15, 20 years. Yeah. And we still haven't put together a significant platform to get it all done without going back and forth with all this crap. Infrastructure should be by itself and not have any other ties to it, because it's it's a common good for everybody, regardless of race, political influence, or whatever. So it ought to be there, because that's part of our, part of how we do business. But
I think what's going to be really interesting, and I'll either be incredibly prophetic or I'll be horribly wrong, and you guys won't remember anyway. But but I think I might be right on this one. The Senate a couple years ago got rid of the filibuster for district judges. And then when Gorsuch, right before Gorsuch came up, they got rid of the filibuster for Supreme Court judges, you know, when they got control of the Senate. And so the handwriting is on the wall that if the Democrats take over the Senate next year, they're going to get rid of the filibuster on voting bills. And then it'll just be majority rule. It'll be like the House. And it's like, you know, if you know, we're going to, you know, vote on it and it'll get passed. And the House passed something like 300 bills, I think it was, last year. And they all, you know, the Senate's like, nah, we ain't going to talk about it. We're not proposing our own.
Yeah, but the big part of that thing is that they normally take a bill and they tie up 5 or 6 things to it that have nothing to do with the bill itself. So
Right.
every bill should stand on its own versus having, you know, a liquor bill tied to an infrastructure bill. That shouldn't make any sense at all. But they do that habitually so they can drag other legislation in behind a major bill. They shouldn't do that. I mean, that should be disallowed.
Right. Well, and you got a situation too where it's the example, the Heroes Act that was passed. That was passed what, 12 weeks ago, something like that. And the Senate didn't do anything. They didn't have it, you know. So they were negotiating, and the Republicans were trying to figure out what they were going to put together, but they didn't actually have a bill, even though they had one from the House. And they're like, we're not voting on that one. We're going to put our own bill out. We'll vote on that. Then we'll take it to committee, you know. But they wasted a tremendous amount of time. And you know, next year that whole thing could go poof, you know, could go bye-bye. And if the cementing of the deal is, heaven forbid, if a judge on the Supreme Court has to retire or pass away prior to January 20th, they're going to put another judge up. And I can guarantee you, I would bet the farm, they're going to end the filibuster on bills. And that's just going to be the end. It's going to be, you know. Now, the good part is there'll be a lot of legislation that probably get done. The bad part is a lot of it might not be good. But, you know, something will be something. I mean, you know, I don't want to say better than nothing, because we got a lot of stuff, you know, we just need to act on. You know, we just got to figure it out. Like the whole high speed to rural community stuff. I mean, that needs to happen a long time ago. So, you know, we'll just see. You know, we'll just see. I'm an optimist. You know, I'm hopeful. You know, we've got a rough patch at the moment. I think this COVID thing will work itself out. The market has every incentive in the world to come up with a vaccine like yesterday. And they're doing everything they possibly can to work that out. And so, you know, we'll see what happens in November. It's going to be really interesting between November and January. That's going to be a fun time, you know, to watch the reality show of the country between those moments. But, you know, eventually we'll figure it out. The market will get itself together. There's still, no matter what's going to happen, there's a ton of liquidity that's going to exist, and that money has to get put to work somewhere, you know. So we just have to stay vigilant as investors in the commercial real estate market. The only thing for sure that's a hot mess right now is retail, office, you know, some of that, there's going to be a lot of transition in that marketplace. I just saw WeWork is having big time financial problems right now, you know, and there's a shift in office to the suburbs from the city. You know, Devon, you could probably comment better on that than I can.
WeWork was having trouble before that even, but you know, in terms of office markets, the feeling is that the suburban office market is going to take off again.
Mm-hmm.
We got 20-30%.
Bust echo.
And that, you know, the downtown is going to take another hit because people, you know, I'm in an 18-story building. They were predicting that in some of the buildings downtown, if they follow social distancing, it would take 9 hours to get all the employees into the building.
It's crazy.
You know, four people at a time on an elevator in a 20-story building. That's a.
Yeah.
Well, that's what happened in my building. You know, I'm on the 19th floor, and it's like, okay, you only get 4 people in the elevator. Social distancing. It's like, man, this is not workable.
So the smaller office buildings in suburbs do have an opportunity to come back.
Yeah.
Yeah.
That's going to happen.
That's what's going to happen. Boom, bust, echo.
Yep. I agree.
Boom,
So it's going to be,
bust, echo.
It's going to be interesting to see, you know, and there's going to be a new normal, right? And there's just some businesses that are just going to.
Well, let's crowd for this office. I mean, a lot of the major companies who own their own buildings, for example, Blue Cross Blue Shield, DTE, they're sending equipment to people's homes so they can work from home, printers and, you know, routers and all that kind of stuff. I know several people they're being replenished for putting offices in their home.
Well, and you know, Devon, I just saw something recently about you know, there's this push to get the schools reopened.
Right.
And they were saying, okay, we go to 100% remote learning. It's cheaper for us to provide every kid with a laptop, you know, and have them learn at home financially. It makes more sense because they're getting, you know, depending on the school district, you know, $6,000 a student.
Yeah.
Right.
Remember who said, "Can we all get along?" Yeah, but that's not going to help to do anything with us living together in the same world. You know,
right.
Ultimately we got to get beyond. Yeah, computers are great. So, but it's a tool. It's not a way of life.
Right. And there's going to be some economic upheaval. You know, the schools, the colleges right now, a lot of them are going 100% remote. And I just saw a Rutgers student did an online petition because they're still charging north of $40,000-$50,000 a year for education. Like, and I'm at home. So shouldn't we get a break on tuition?
Yeah.
You know, and initially we're like, no. And then her petition went viral, and then other people in other schools took that petition, started duplicating it, and they said, okay, we'll drop tuition by like 10%.
They got to spread it out. They got to do some separation, but you can't not take away socialization because that is a very important part of overall education and growing and development.
Yeah.
Right. It is, and that's just another industry that's going to have a huge, what they call it, disruption.
Teachers, you know, more classes, just, you know, spread it out.
Right.
Don't take it away.
Right. Well, listen, guys, I want to thank you guys for being on our call. We'll be right back at it the first week in September.
By the way, any ideas for what you'd like to see first week in September?
Yeah, any ideas, guys, what you guys want to cover that first week?
I'd like to have a more detailed conversation, or let's say an updated or relevant conversation with what's happening with the stimulus monies. So we have, you know, maybe some, you know, month end or year to date, end of August, year to date unemployment numbers, and you know what that would look like in Michigan and other places, you know, for you know, foreclosures, forbearances, evictions, et cetera.
Yeah. One comment. Our next meeting is September 4th, I believe. Most of that data won't be available to mid-month.
Oh, yeah.
If you wanted it based on a month-end situation, now we can do up to that date and give you probably you know, up through July, but August will be missing probably. But I mean, we can take a snapshot and kind of tell you what it's looking like. But.
Right. And we may have an idea at
Yeah,
that
no,
time
will be out until later on.
what the next stimulus package is going to be for small business owners.
Well, yeah, we
Right.
can do some version of that. It may not be totally accurate again because it's still early in the month. And
Sure. Yeah.
yeah, but that's fine. We can certainly. Maybe that should be a part of every. While all this stuff is going on, probably a couple of slides on just a snapshot of the economy.
Yeah.
Yeah,
Curves we're talking about. Give me a
yeah,
snapshot.
I agree.
What's going, what things are, unemployment, you know, incentives and the GDP, where it is versus all that stuff. So you snapshot.
Sounds good.
Right, I agree. I agree. And now it's more important than ever to have your finger on the pulse of the market and where it's at, what it's doing. Yeah, obviously the economy and how it's being affected. It's never been more vital because things move very quickly. You know, just like that PPP money. You say, oh, this program's out. You know, oh, it's closed down. They're out of money. I mean, you have to be on the spot.
Somebody's boy.
Yeah, yeah. You really, unfortunately, you really did.
For you. Hey, man.
Because if you were just reading about it in the paper, it was too late.
You're right.
It was way too late. So yeah, we should definitely integrate that. Well, I want to thank you guys for participating. Be safe out there. You know, if you have any questions afterwards, there's my number and everything. And feel free to give me a buzz. Send me an email. You know, I'll be more than happy. Oh, and check out our new YouTube channel. We made some updates. We updated our logo. We added, a couple new videos. We're going to be adding some more content going forward. It was a good time for us to rebrand. And I appreciate you guys' feedback, and let us know what you think. So anyway, thanks, guys. Have a great day, and see you next month.